Hey, what is going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and in today's video, we're going to be talking about how housing affordability has plummeted. And of course, we're going to be discussing whether or not there is a housing crash in our future. Now, in order to do this, we're going to be looking at the median home price, median household income, and of course, mortgage rates. Now, if you are new to the channel and you like all things finance, real estate, and investing, please consider hitting that like button and that subscribe button right there. And if you wouldn't mind, please leave a comment. It really helps me as well as others learn and grow. Now, without further ado, let's jump right into the data. All right, so up on the screen, I have a chart from Fred Economic Data, and I have customized it to show us the median household income in the United States, as well as the median sales prices of homes sold in the United States. Now, I've gone back to 1985 all the way up to present day. The income side of things only shows up to 2020. I guess they haven't got the reporting for 2021 yet, but we'll discuss that because I pulled some data from Google here as well. So there are a couple key points that I want to bring to your attention. And a lot of this has to do with what we call the price to income ratio. That's what we're evaluating here today, is how much the sales price of a home is versus how much the median household income is. Now, we're just doing this as an average. We're looking nationwide here. But you can see the blue line is actually the median household income up on the screen, and the red home is the median sales price of houses in the United States. Now, if you look at that blue line, what do you think that looks like? So it looks like just a very steady line, right? It's steady, it goes up slightly, it doesn't fluctuate much, it just stays relatively stable. And that really is on par for what we've seen with inflation over the last several decades. We've just seen inflation maybe 2-3% per year, very steady. Wages generally go on a lag, but they follow inflation. So we've just seen a relatively flat line. Now, take a look at the median sales price of homes. So this arguably stayed really flat as well, and it steadily goes up. But what happened from 2004 all the way up to 2006, 2007? We saw a huge peak in real estate. So now if you look at the chart here, in 2007, the median household income was just over $50,000, while the median sales price was $257,000. Now, the way you calculate the price to income ratio is you simply take the median sales price and you divide it by the median household income. If you do that, the actual price to income ratio there is 5.14, meaning if you have a $50,000 median household income, the average sales price is 5.14 times that amount. Nobody would argue at this point that we were in a bubble in 2006 and 2007, right? We obviously went into the great financial crisis at that point, and we saw prices come down, and they actually reverted back to the trend line there. We arguably bottomed out here in 2012, and then we went on a steady increase up. So this chart is the average 30-year fixed mortgage in the United States. If you go back to 2007, just to see what the average mortgage rate was at that time, right as the bubble was sort of peaking, we were at 6.14%. And then you saw as the years went forward, we started to see the interest rates come down into 2012, and they basically came to a bottom of about 3.32%. Now, at which point, if we're toggling back to this chart and we're looking at median home prices, we started to see prices go back up. Now, they went up on a relatively steady pace here, as you can see, and they went down slightly in March of 2020 when the pandemic hit, followed by an explosion of home price growth. The median home price as of the first quarter of 2022 is now sitting at nearly $430,000. And I did a quick Google search to try to find the median household income in 2022, and so far they are estimating that at about $79,000. So if you were to take $428,000 and then you were to divide it by $79,000, it would put our price to income ratio at 5.4, which is slightly higher than the peak that we saw in 2007. So if we were in a bubble in 2007, what does that mean for us right now? Now, of course, mortgage rates today have fueled some of that price growth. Obviously, we saw a huge spike in housing prices in March of 2020 and and moving forward into 2022 while we had record low interest rates, as you can see here on this chart. More recently, we've seen a massive spike in rates. We're now on average sitting at about 5.3%. So that rise in interest rates is starting to cool things down a little bit. And if we toggle back over to the median home price, you can see that we're no longer going straight up. We're starting to see prices starting to curve and roll over a little bit. So housing prices generally shift a little bit based on where the interest rates are, but it's at a lag and it moves a little slow. So does that mean we've reached a top? Does it mean we're rolling over? Does it mean that prices are going to come down? Only time will tell, but we will see as the months and years unfold here. All right, and the last chart that I want to show you is home prices that are adjusted for inflation. I think this is really cool and really important to pay attention to. So the blue line represents home prices in nominal terms, and you could see decade after decade they have gone up, and they peaked out in 2005. They crashed into 2012, and then they peaked up again here in 2021, and even higher in 2022. We might finally be at a point where they're starting to level off a little bit. But you can see that there has been steady growth decade after decade of home prices, at least in nominal terms, increasing. Nominal means in price alone. So in other words, if you had a widget that cost $10, goes up to $20, the price has increased by $10, but that is not adjusting for inflation. Now the orange line, on the other hand, is home prices adjusted for inflation. So if you take a look at this chart, it goes back to 1906, you can see that home prices adjusted for inflation stayed relatively flat for decades. It peaked in 2005, where it actually broke that average trend line. But then it reverted to the trend line back in 2012. That's when home prices bottomed. And now we're starting to see that home prices adjusted for inflation are now higher than they were in 2005. So at some point, in some way, home prices will have to revert to that trend line. The question is will it be in nominal prices, or will it be adjusted for inflation? Now, just because housing prices adjusted for inflation are at a record high level, does this mean that the market is going to crash? Or do you think we can actually sustain at these prices? Well, there's a couple things that could take place that will allow housing prices to remain stable. One of them, of course, relies heavily on interest rates. Couple points here. If interest rates go back down to those record lows that we saw just last year, if they're in the mid to upper 2% range, absolutely housing prices can stay level, maybe even increase a little bit from where they are today. The other thing that not many people are talking about is if more mortgage products become available. There's already been a rise in applications for adjustable rate mortgages, but on top of that, if they expand the amortization term, let's say they start looking at a 40-year fixed rate product, that will increase affordability and ultimately allow us to sustain higher price levels in real estate. Now, the other way that home prices can stay elevated and even get a little bit more affordable in real terms is that we can see wage growth. If wage growth starts to bump up and keep pace with inflation, then there's really no reason why the housing market or home prices need to come down at this point. Now, with that said, if we do not see lower interest rates or an expansion in mortgage products, and of course we don't see any wage growth, then at some point, affordability will just be out of reach for the majority of home buyers out there, and we will likely need to see home prices in nominal terms come back down and revert to that trend line in order for things to become affordable again. I'd like to hear from you. What do you think will happen? There is so many moving parts in this market. We're seeing record high inflation. We're seeing record high home prices. We're starting to see interest rates move up. What do you think is going to happen? Please leave a comment below. That is all I have for you today. Please, if you haven't done so already, consider liking and subscribing. We'll see you on the next video.